Hello. I want to review some of the key topics from Chapter 1 and 2 because I think this will help you learn the material and also prepare for your test. To start with, it's important that you know the definition of accounting. Accounting is an information system, and that's key. It's not math, it's not tax returns. It's about producing information for users. Also, it's very important that you fully understand the accounting equation. The accounting equation says that assets equal liabilities plus owner's equity. That's an algebra equation, which means you can do a couple of things with it. One, you can rearrange the equation algebraically. For instance, assets minus liabilities would equal owner's equity. Also, it's important if you know two parts of the accounting equation that you can solve for the third part. For instance, if you know assets and you know owner's equity, you should be able to calculate liabilities. Assets are owned resources of the business. Those can be physical things like computers or furniture or equipment. They could also be intangible things like patents or trademarks. Liabilities, I want you to think of as debts or obligations of the business. Usually those are things the business owes, but that's not always money. Sometimes it could be services. For example, if you receive a down payment as a business, you now have a liability to provide that product or service to the customer or give them their money back. Equity is sort of the tricky part. Equity is really the difference between assets and liabilities. Another way of saying is it's the residual interest or the owner's interest in the business. And I like to think of it this way. If you took all the company assets and used them to satisfy all the company liabilities, any assets that left over would belong to the owners. So they're a measure of the owner's interest in the business. Also, I want you to remember that 4 items change equity. 2 of them cause equity to increase, 2 of them cause equity to decrease. Expenses and withdrawals cause equity to go down. Revenues and investments cause equity to go up. That's an important concept to know and understand as you manipulate that accounting equation. Also, it's important that we talk about the 4 financial statements. The income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows. Financial statements are prepared in that order, starting with the income statement. The income statement has 2 key pieces, revenue and expense. The difference between revenue and expense is profit, which in accounting we refer to as net income. Also, I want to point out that the income statement covers a specific period of time. The statement of owner's equity measures what happened to the owner's interest during the accounting period. For instance, how do those 4 things that change equity, revenues, expenses, investments, and withdrawals, affect the balance in equity? We hope that we're profitable, which causes equity to increase. If the owners take out some of that profit from the business, that will cause equity to decrease. Statement of owner's equity tells users what happened to the owner's interest over a period of time. The balance sheet. The balance sheet is the financial statement representation of the accounting equation. Assets, liabilities, and owner's equity all get their own section on the balance sheet. And the total assets should equal the total liabilities and owner's equity. The balance sheet's different from the last 2 financial statements though, because we measure the balance sheet at a specific point in time. For instance, as of 12/31, as of that last day of the year. And usually the balance sheet is dated as of the final day of the accounting period that the income statement and statement of owner's equity cover. Statement of cash flows tells us in detail what happened to cash. And cash is very important. However, the statement of cash flows is not a financial statement that we're going to be focusing on in this portion of the class. The financial statements are prepared in that order. We need the net income off the income statement first before we can see how income affected equity. And we need to have that statement of equity prepared so that we can complete the owner's equity section of the balance sheet. Lastly, the chapter talks about some entities, sole proprietors, partnerships, corporations, and LLCs, or limited liability companies. And you'll want to know the characteristics of those four types of business entities. In Chapter 2, the key thing I want you to know is debits and credits. You have to memorize the rules of debits and credits. And the rules are simple. Assets and expenses increase on the debit side. Liabilities and revenue, they increase on the credit side. Consequently, assets and expenses are said to have normal debit balances. Liabilities, revenue, said to have normal credit balances. Now, the way we deal with equity is a little tricky here. Equity normally has a credit balance, but I want you to keep in mind that those four things that change equity, revenues, expenses, investments, and withdrawals, well, revenues are credited to that capital account. Expenses are debited to that capital account. Investments also credited to that capital account. Ownership withdrawals debited to that withdrawals account. In general, equity is going to have a credit balance. Now, debit and credit, they confuse people a lot. All debit means is left side. Goes in the left side of the T account. Credit just means right side. Goes in the right side of the T account. Doesn't mean anything else, and I don't want you to try to attach any special meanings to it. These rules are the opposite of how you think of debits and credits when you think about your bank account. So don't think to the bank account when you remember these rules. You've got to know how debits and credits work. If you memorize those rules, you'll be way ahead as we move on to future chapters. Hope that review has helped you this morning, and good luck with your test this weekend.